because of this, commercial real estate values soared between 10 to 30% depending on the type of property. And banks were the ones issuing all of these low interest rate loans because they were flush with cash. However, now that interest rates have increased at the fastest pace ever in history, there's a problem. Commercial real estate values are plummeting, with Morgan Stanley estimating that the entire market could decline 40%, which is the same magnitude that we saw throughout the 2008 financial crisis. Why is this such a big deal? Well, as CNN explains, US banks hold about $2.7 trillion in commercial real estate loans, and about 80% of that is held by smaller regional banks, the ones the US government has not classified as too big to fail. Now, unlike most normal real estate loans that you and I would get when going and buying a house, commercial real estate loans are not fixed for 30 years. Instead, these interest rates often reset after 3 to 7 years, much like the introductory rate mortgages that we saw in 2005. And according to the data firm Tripp, more than $2.2 trillion will come due between now and the end of 2027, so regional banks could have problems collecting on these loans. After all, commercial real estate values are almost entirely dependent on two factors: how much a property earns and how high interest rates are. In this case, the higher the rates, the higher the return an investor needs for the deal to make sense, and as a result, values drop. Like, just imagine in really basic terms that you have a $1 million building that makes $60,000 a year, which is a 6% return. If interest rates decline to 1%, that building could sell for $1.5 million, or a 4% return, since you could borrow at 1% to make 3% in profit.